This week on Moving Markets, a potential new listing from Sime Darby. Mixed earnings amongst Malaysian REITs, the world's soon-to-be largest IPO drives up the Hong Kong dollar, and US markets eagerly await a new stimulus deal. Sime Darby is no stranger to a corporate spin-off. After all, we have three listed entities: Sime Darby Plantations, Sime Darby Property, and of course, Sime Darby Berhad. But could we see another one from them in the near future? Earlier this week, Bloomberg reported that the company is mulling a spin-off of its healthcare arm, Ramsay Sime Darby Healthcare, which runs 3 hospitals in Malaysia and several others in Indonesia and Hong Kong. This might mean an IPO which could raise an estimated 500 million ringgit for the new listed entity. Now, why do companies do this? One widely believed view in investments is that big companies with diversified businesses tend to be valued on the whole less than what you would get if you summed up the value of its different parts. That's called a holding company discount, also known as a conglomerate discount, and one of the biggest conglomerates in Malaysia, Sime Darby. So what Sime Darby could be trying to do by listing its healthcare arm is to eliminate the discount on this unit and unlock value by reorganizing and listing it as a separate entity. In other words, it is monetizing its assets. For Sime Darby, its healthcare arm has likely reached a certain size and has profits which warrant a separate listing. After all, if we look at other hospital stocks in the region, the average valuations are still attractive at a price-earnings ratio of 67 times. So it looks like Sime Darby could be raising some serious money via this IPO. It's not the easiest time to be in real estate, and we see that in the earnings from the REITs this week. The key takeaway here is that in the age of COVID-19, the likes of Axis REIT turned out to be better suited to weather the movement control order since it's an industrial REIT. So they own property like warehouses which have been quite resilient. But it's not such good news for retail REITs like Pavilion, which saw net profit fall by 46% in the last quarter. We all know Pavilion Mall in Bukit Bintang, and they also own Damen in USG Subang. But with COVID-19, you can imagine lower foot traffic in the past few months would have been devastating to all the shops. So the ability of REIT managers to raise rents or even renew leases with tenants will be challenging, unlike industrial REITs where tenants tend to be more sticky. We're now one step closer to seeing what's likely to be the world's biggest IPO. Ant Group, the owner of Alipay, is seeking a listing both in Shanghai and Hong Kong, and it has now cleared all the regulatory hurdles. And ahead of the IPO, one knock-on effect has been the Hong Kong dollar, which has strengthened as much as it possibly can. Investors have been buying the city-state's currency in anticipation of participating in this IPO, driving it up. But of course, the city-state's currency is pegged to within a certain range of the US dollar. The Hong Kong dollar has risen in value not only because of the Ant IPO, but also because the US dollar has become less attractive after the US Federal Reserve moved to lower interest rates to close to zero earlier this year. And lower interest rates mean lower yields, lower demand for the dollar, and ultimately a weaker US dollar. This week in the US, the news about a new stimulus deal before election day or lack thereof was the key event driving markets. It's been a long game of will they or won't they, but stocks ended the day higher on Thursday after House Speaker Nancy Pelosi said a new deal was just about there. But regardless of whether they can reach an agreement by the end of the week, it will still take time for lawmakers to actually write and vote on the bill. And that's what's been moving markets.